If you're selling a property in Maryland and you're a non-resident, you may be subject to Maryland withholding tax. And this is a surprise that you do not want to have at the closing table. I'm Realtor Rebecca Cole with Berkshire Hathaway, Homesale Realty, and I help people buy and sell real estate in Maryland. If the state of Maryland determines that you are in fact subject to Maryland withholding tax, 8% of the total payment is due before the transfer deed can be recorded, 8.5% for a non-resident entity. So what exactly is Maryland withholding tax? Who owes, who's exempt, and how much do you have to pay when you sell your home? Today, I'm going to answer these questions and give you some valuable resources towards the end of the video. In 2003, the General Assembly enacted Section 10-912 of the Tax General Article, which provides for income tax withholding for the sale or transfer of real estate property by non-resident individuals and entities. This was partially in response to out-of-state companies coming into the state to buy and flip properties for profit. Maryland saw a huge opportunity to earn revenue on these sales and enacted legislation to get a piece of the pie. But the law also affects many people who own property in Maryland but no longer live in the state. If you bought a home in Maryland a few years ago and relocated to another state, Maryland considers you to be a non-resident, and they want their money when you sell the property, unless you can show that the house qualifies as a primary residence, in which case you're exempt from paying Maryland withholding on the sale. To be considered a primary residence, you must have lived at the property for at least 2 of the past 5 years, filing Maryland resident tax returns at that same address. And your capital gains must be under $250,000 for an individual or $500,000 for a married couple. Keep in mind that any person on the record of deed is taken into consideration on the sale. This includes children that have been added to the deed for inheritance purposes. A common situation where Maryland withholding comes into play is when someone lives out of state and they're selling a rental or investment property. It's also common to see on estate sales where the trustee lives in another state. So let's say you bought a house in Maryland and lived there for 5 years before you moved to another state. You kept that house in Maryland and used it as a rental property for the last 6 years. Under the guidelines, Maryland withholding would be due on the sale. Now let's use the same scenario, but let's say you moved out of state 2 years ago and you lived in the property for 3 years prior to that, filing your tax returns at that address. Under the guidelines, the house would qualify as a primary residence because you lived there 2 of the last 5 years, and Maryland withholding would not be due on the sale. Another scenario. Let's say you and your spouse added your adult child who lives in Florida to the deed of your house here in Maryland a few years back with the intention of the house transferring to them upon your death. Let's say your situation has changed and you now want to sell the property. Maryland withholding, or 8% of the total tax payment, may be due on the deed transfer when it's recorded with the new owner, because one of the property owners, your adult child, is not a Maryland resident. Total payment is defined by the state of Maryland as the total sales price less any debts secured by a mortgage or lien on the property and expenses associated with the sale of the property incurred by the seller. Now keep in mind the title company facilitating the closing is the one responsible for ensuring that sufficient funds are withheld from your proceeds so the deed can be recorded and transfer ownership to the new buyer. What happens if there's a discrepancy in the amount of money that is collected from your proceeds by the title company at closing and what you actually owe? The sale of Maryland real estate property has to be reported on a Maryland non-resident tax return at the end of the year as a source of income or loss. The withholding funds collected at the time of the sale is then applied to the tax due, and a refund of any overage is then issued. So if you sell a property in January or February, that money would not be reconciled until your tax return is filed the following year. That is a long time to have money held up, especially if the funds collected at closing are much higher than what you actually owe. A tentative refund application form may be completed 60 days after closing. This is an opportunity to recoup some of the funds back ahead of the mandatory income tax return filing required at the end of the tax year. And there are a few exemptions of the Maryland withholding requirements. These include foreclosure and other special circumstances approved by the comptroller. An application for a certificate of full or partial exemption may be filed no later than 21 days before the date of closing. The application may be found at the comptroller's website at www.marylandtaxes.gov. If you'd like more information on buying, selling, or living in Maryland, reach out to us. My contact information is below. And if you found value in this video, give us a thumbs up and like or subscribe so you don't miss any of our content.